What is going on in the U.S. housing market? We had another pair of ugly misses in home prices as well as home sales. Prices were down by the most in 3 years, while new home sales crashed by 13.7% in May alone. Maybe most important of all, it's the southern region that's leading the downturn. And in the South, new sales were down 21%. If there is a bust that's really starting to take shape, at least we will know why, however small that consolation might be. Over the past few years, the real estate market has been propped up by slightly more buyers over sellers. But in the past 12 months or thereabouts, the equilibrium has shifted, as we'll see. Consumers simply fear for their jobs, so naturally they're staying away from home purchases in big numbers. And yesterday, the Conference Board reported an, quote, unexpected drop in consumer confidence, and that's here in June, as American concerns about employment refuse to go away. And so these growing housing woes also confirm what would be the negative case for the overall economy. It isn't just negative confidence or sentiment. Consumers aren't just saying they're pessimistic. They do appear to be altering their behavior and maybe doing so in a big way. So much so, even central bankers at the inflation-biased Federal Reserve are starting to have second thoughts. Powell told Congress the economy and the labor market are solid, but fewer people actually believe them. Fewer markets are buying it, outside the NASDAQ, of course, and even fewer members of the FOMC are willing to agree with him as a very public split on the committee starts to spill over in public. And of course, less waffling from the wafflers means less interference from the Fed, and therefore lower uncertainty over the future path and timing of short-term interest rates. The possibility of a housing bust only adds more to this growing downward yield bias that we're seeing across the bond market. Now, we've already covered the housing story and the bull steepening of the yield curve at Eurodollar University's deep dive analysis, but just to go over the latest developments here, the 10-year Treasury yield is down to around 4.29%, putting in a multi-week low. More importantly, the fundamental twos, and really we should show some love to the 3-year maturity too. The 2s and 3s are at 3.75% as of yesterday's close, which puts them back around where they were May 1st. And more importantly, in the range of the April and even last September lows. As the bond market continues its noticeable bull steepening, more and more are being drawn into what that bull steepening actually means, the downside case in the U.S. and global economy, with more emphasis on the U.S. part of it as we see more of these increasingly ugly numbers from places like the housing sector, consumer confidence being confirmed as more than just negative confidence, and a whole bunch more beside. Overseas central bankers who see the same increasing worries about their own economic situations, especially when it comes to labor market and jobs. And it all adds up into something that Jay Powell just doesn't want to admit. But as Bloomberg reported today, traders are ramping up options wagers that 10-year Treasury yields are poised to sink to their lowest since April, amid dovish comments from the Federal Reserve officials and a backdrop of simmering Mideast tensions. That seems to be going away, and it's not really about Mideast tensions anyway. It's about the macroeconomic fundamentals. This would also mark a sharp reversal from peak levels of above 4.6% for the 10-year seen in May, when mounting worries around government spending in the U.S. and other major economies sent long-term yields soaring. And that last part is just completely wrong. That was a media creation. There is no market rejection over long and short end doesn't matter. There's no market rejection over debt and debt issuance. That was simply a fluctuation mainly created, as I told you before, by the waffling among central bankers, particularly in the United States, also Japan, over this inflation narrative. The more uncertainty that Federal Reserve officials could throw into the marketplace, the more that got priced into the 10-year maturity because the fundamentals were sticking with the 2s. And that's exactly what has happened. And as the bull steepening case has further developed since then, 2-year yields are going down, the front end is going down more, but the back end is coming down too. Again, classic bull steepening. Not worries over government spending, not worries over inflation, fundamentals. And as they become clearer, and as the Federal Reserve officials get themselves out of the way, going back to the article here, Treasury options skew now favor calls across the strip, signaling traders are now paying a premium to hedge against a bigger bond rally versus a sell-off from the front end out to the long end of the curve. Again, bull steepening. Long bond skew is now favoring call premium for the first time since April, when things were really falling apart. In 10-year options, demand over recent sessions has emerged for upside protection, targeting a move in 10-year yields down to near 4%, thereabouts, via August call structures. And if the housing market really is beginning to crack, and finally from macro reasons, as we'll see, they can call it an affordability crisis all they want, but all it really means is fewer buyers because fewer jobs, lower income opportunities, and maybe even worse than that. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. Today's big data was from the Census Bureau, new home sales for the month of May. Now, the expectations were that home sales would dip a little bit because they were elevated somewhat in April, had quite a big rise in April, and so there was an expectation they would come back down somewhat, but they came back down more than the rise in April and then some. It was a 13.7% month-over-month hit, the biggest monthly decline since June of 2022, when the oil shock and the shock from interest rates, higher interest rates, really started to pick up and register. But this is different from 2022, and it's also different from the last housing bust 20 years ago. The seasonally adjusted annual rate for May, new home sales, was just 623,000, way below the 700,000 thereabouts that was expected. In fact, that's 6.3% below last May, which had a rate of 665,000. And this just merely confirms what we said a couple days ago in the video on resales and existing home sales, that this is the worst start to the spring housing season, housing selling season, since 2009, and this absolutely confirms it. By region, sales were down pretty much across the board. In the West, 5.4% lower in May, 7.1% lower in the Midwest, and in the South, a 21% drop in the month of May in the southern region. And that's the concern, especially Florida, where Florida's key markets, in fact, most of its markets, are seeing prices outright drop, which is the canary in the national coal mine. And it is set to get even worse. The latest housing results show home builders are sitting on rising inventories amid mounting economic challenges, including mortgage rates stuck near 7%, not so much, higher materials costs due to tariffs, and I can't believe they threw this in here, finally some truth, a slowing labor market. It might be more than slowing or worse than slowing, but at least they throw that in there for once, rather than just saying, oh, Jay Powell's got rates too high. While builders are offering subsidies to reduce customers' financing costs, the concessions are yielding diminishing returns and encouraging many builders to slow construction. And the reason why this affordability crisis isn't really about mortgage rates or even home prices. It's about incomes. To begin with, incomes never grew nearly fast enough, not anywhere close to as fast as prices did, as we'll go over the numbers in just a second. But more importantly, looking ahead, consumers are saying, we don't see the jobs, we don't see the income growth. We're not going to go buy a house or even investigate buying a house, regardless of where interest rates or prices are. This is about the labor market and the fact that consumers do appear to be changing their behavior based on their perceptions of how employment really is, and it's not solid like Jay Powell keeps claiming. And as a result, back to the article, the home sales report showed a slight increase in the number of new houses for sale, but that's to the highest level since 2007. And this represented 9.8 months of supply at the current sales rate. And the number of completed homes for sale rose to 119,000, which is an almost 16-year high. In other words, the housing market really is starting to show signs of substantial strain. Now, whether or not it keeps up over the rest of the summer remains to be seen, but as an initial confirmation of the possibility that we're seeing an honest-to-goodness macro-driven housing bust, that's where the evidence keeps coming in. And it makes sense given everything else that we've talked about, the market positions, long-run market positions, what swap spreads have been pricing for years, the yield curve, even central bankers that are coming around and saying, you know what, we're kind of worried about the labor market too. And if the housing bust is being driven by the labor market, that gives them another reason to just get with the market program as well. Yesterday, the U.S. government, the Federal Housing Finance Agency, they reported a sharp drop in home prices for the month of April. In fact, their housing price index, their purchase-only price index, was down 0.4% in the month of April, which is the sharpest monthly decline since July of 2022. In fact, that's the only monthly decline in the index going back to that point in 2022. And that follows the previous 2 months in February and March, where the government says home prices were basically unchanged in both, just up fractionally in February and fractionally again in the month of March. So home prices have stalled, at least according to the FHFA, going back to February, which is right around the time when these job fears accelerated. When consumer confidence dropped and then dropped even more, consumers really do appear to have shifted their behavior, maybe in terms of selling houses too, but at the very least, buyers aren't showing up. And that has left the housing market with fewer buyers and maybe some more sellers, and therefore it shifts the equilibrium away from where it's been over the last couple of years. Now, this housing market situation, even the bust, if it continues to develop, it's vastly different from the last one, the big one from the early 21st century. That one was a mortgage and debt crisis, which made it a true housing bubble. Volume soared as everyone bought a house, new as well as existing. People had jobs and income growth, and those were overall solid, not great, certainly not compared to the 1990s, but they bought more houses than they could afford on overly generous credit terms. Remember the ninja loans and 3% down payments and all these affordability programs that were out there just to get people in to sign up for a mortgage. So credit availability was what was out of whack, pushing people to buy and therefore creating more demand than there otherwise would have been. That's not what we see here in the 2020s. Overall, I've got much lower volumes, especially in home construction, which is a whole separate topic that deserves an entire video just on that one. It's related to the lack of credit availability and favoring investment funds over people buying houses to live in. But anyway, lower volumes here in the 2020s is not really driven by out-of-control credit. It started during the COVID pandemic, the lockdowns, driven a lot by spare cash of people using for down payments. Investment funds that were flush with cash went looking for properties and investments because everybody's convinced the dollar was going to go to zero. And once rates rose, the frenzy died down a little bit, but the market hasn't been stable over the last several years that forgot how to grow. Prices had soared way above the average person's ability to buy. And that's the so-called affordability crisis. It's income, not interest rates. In fact, you look back at the FHFA's index, it rose by 54% between May of 2020 and the latest data for April of 2025. 54%. Incomes have gone up nowhere near that. And for the average worker, it's not even close. So like the overall economy in the housing market, it experienced a supply shock. There wasn't enough supply, and there was, in the initial stage, a lot more demand, and then over the couple years since then, forgot how to grow, demand has been slightly higher than supply, keeping prices moving positive. And as investors pushed up home prices and out of the reach of people who would use houses as shelter, it got even more out of whack in the fundamentals. But all that seems to be flipping. Now there is more supply, there's more selling. At the same time, there appears to be fewer buyers out there as they are afraid more and more of jobs and incomes, as I keep saying. And therefore, they really are altering their behavior. We can see it in the housing market, which is key confirmation of this overall broader economic theme. What we've been hearing ever since this really showed up earlier in the year is that, as Jay Powell said a couple meetings ago in the month of May, well, yes, consumer sentiment is bad and it got even worse, but it's only consumer sentiment. That it was just pure emotion. Reading between the lines of his statements and subsequent statements since then, he was basically saying consumers were overreacting to tariffs. And that's all it was, just an overreaction to tariff fears. But what we've seen since then is more and more confirmation that, first of all, these are job fears, not tariff fears. And second, consumers are indeed acting on those fears, not merely venting to consumer confidence surveyors. Spending has been weak, as we've been pointing out, and that's already evidence of the pullback there. Now, if we have to see the same thing in home buying, where we are getting a bust and a shift in the equilibrium, that's another solid bit of proof that consumer behavior is being changed and it's being altered, not by tariffs and trade wars, by the labor market, by jobs and incomes, by rising unemployment, not just concerns, but actual rising unemployment. As I've shown before in the latest payroll report, when you adjust for labor force dropouts, which you absolutely should, the adjusted unemployment rate is closer to 5%, not stuck around 4.2%. And it's moving higher, not in a straight line, because nothing ever goes in a straight line, but it's moving higher. And it does seem to be more and more confirmed by all of these macroeconomic developments, up to and including the possibility of a housing bust that we're seeing here. And it was jobs for why the Conference Board's measure of consumer confidence unexpectedly declined here in the month of June. Analysts were figuring that their index would rise to around 100, and instead it retrenched all over again, dropping down to 93, falling 5.4 points in June, not far from the April low of 86. And the expectations index for the Conference Board fell 4.6 points all the way back to 69, which the board points out is well under the 80 threshold. They say signals a recession ahead. So rather than improving with share prices and tariff delays and all the positives that are supposed to be out there in the economy, consumers fell over again. And why? The share of respondents saying jobs are plentiful fell to 29.2%, which is the lowest in over 4 years. Meanwhile, those who are saying jobs are hard to get was little change from last month, which wasn't a good number last month. And when you put those two together, the difference between those who are saying jobs are plentiful and those who are saying jobs are hard to get, that one dropped to just 11.1 percentage points, which is the worst for the Conference Board survey since March of 2021. So you can see where Bowman and Waller are coming from, not to mention the market. This growing concern over jobs is still there in the consumers, even despite all the assumed positives over the months since the April downturn, the liquidations and deflation. The economy is showing scars and signs of a growing downturn, not one that was fixed by trade deals or possibility of trade deals and tariff delays. Even Reuters had to come out and admit U.S. consumer confidence unexpectedly deteriorated in June as households increasingly worried about job availability, another indication that labor market conditions were softening against the backdrop of, they put, rising economic uncertainty because of the Trump administration tariffs. And it's really just a forgot how to grow economy that was fragile and heading in the wrong direction before we even got started this year. The ebb in confidence reported by the Conference Board on Tuesday was across all age cohorts and nearly all income groups. It was also across the political spectrum, here's the thing, with the largest decline among Republicans. Not just partisanship, not just fears over uncertainty, not interest rates or all the excuses that come out. This is about jobs and incomes and about how the fact that consumers are changing the way they behave, the way they spend, the way they think about spending, and we're getting confirmation from all over the spectrum. So the housing market is in danger of a macro-led, not a mortgage-led bust. It's basically a jobs downturn. We're getting this initial confirmation from prices, from volumes, from sales, all of the key metrics, especially those in the southern region. So consumers who are pessimistic on jobs and incomes, they're not going to go out and take mortgages or buy a house regardless of interest rates or any other factor. It really comes down to employment. And if the economy had actually recovered the past few years, interest rates wouldn't even be an issue anyway if incomes had kept up with price changes. But as we see across the entire economy, not just in the housing sector, they never did because there was no hot economy. There was no recovery. There was only a supply shock, price illusion, and then forgot how to grow. And that starts with consumer behavior and the very real and growing possibility that labor market woes are already translating into changes in consumer spending and consumer buying over and above just negative sentiment. And we're getting more confirmation, more widespread confirmation by the month. So I guess that means NASDAQ 100,000. I never make predictions, but I made one about the Federal Reserve in the video link below that looks more and more likely by the data point. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.